In other business news, Growthpoint Properties is predicting that high global interest rates will continue to be an issue long into 2025. The group's comments come despite its share price rising sharply in recent months on the back of market expectations of monetary policy easing. The 50% shareholder in Cape Town's V&A Waterfront has further announced a double-digit drop in distributable income for 2024, which is down from the previous year. As a result, the stock shrinked more than 3% in early trade following the announcement of the latest annual results. CEO Estienne de Klerk speaks to us now. Thank you so much for your time, Estienne. Now, the group has flagged that its dips for the current financial year are expected to decline by up to 5%. Talk us through the impact of that.
Yes, so obviously, as you mentioned earlier, the interest rates, not only within South Africa, where interest rates have gone up 4.75%, but also internationally, where we operate in Australia, Eastern Europe, and the UK. In all those jurisdictions, we've seen marked increases in interest rates. And even though we have fixed our debt over time, the hedges, the interest rate hedges that protect us against these increases roll off, and that has a negative impact on actually a business that actually is performing quite well fundamentally. So if we look at the property fundamentals, those have actually performed particularly well, and most of the key performance indicators, vacancies, turnover in terms of our hotel rentals, as well as the actual arrears. So all the metrics that we measure within the property environment has actually improved quite a bit.
And that's interesting because the latter then speaks to the improvement in overall sentiment in the business cycle in South Africa. Where do you stand in terms of your view on the property sector in the country currently, and maybe a near-term outlook into positive gains?
Yes, I'm very confident that, if we look forward to FY26, that, we'll see Growthpoint return to growing distributions. Just to contextualize, in this year, we had to wear additional 612 million rand of additional interest due to the very sharp rise in interest rates. Now, as those flush through the income statement and as income grows in our portfolio, and we do expect our income in all three the sectors we operate in, which is office, retail, and industrial logistics, to see all three those sectors grow. And we've also been able to let quite a bit of vacant space in this past year. So I think all those things are reflecting on, if we reflect back on the year, it's been a marked improvement. And looking forward, we're reasonably confident that interest rates will probably be coming down. We don't know when or exactly or at what velocity they'll be coming down. But certainly, if we look at our economy's performance, they should be coming down. And that will immediately have a wonderful benefit for the industry, not just directly in terms of the cost of our debt, but also in terms of the confidence with our tenants to commit to leases again, to grow their businesses in this economy. And specifically in Gauteng, we certainly need that.
Speaking of interest rates, the uncertainty around not knowing when they will start coming down or at what rate, how are you expecting to buffer against the high and elevated monetary policy as it stands? Because it is a matter that has been with us for almost a year now.
Yes, so as I mentioned earlier, we have a policy where we put hedges in place, and these are instruments that fix your interest over a period of time. Now, obviously, this is not infinite. The average length of those remaining is just over 1.5 years still. And the reality is that as those interest rates roll off those hedges, then we into a higher interest rate environment, which we effectively paying the higher interest. And there isn't really all that much you can do other than potentially reduce your debt. And what we've actually done in this regard, even though we're actively investing into South Africa, is we are disposing of, let's call it, non-strategic assets, some of our smaller quality assets that we are selling into the market, and we're taking that money and using it for our developments, but also the intention is to reduce debt with it. But I think, from where I sit, I think we'll start seeing probably interest rate decreases from the September meeting that should be coming up at the Reserve Bank, and hopefully, we'll see decreases in the next 3 to 4 meetings going forward.
As a final point, how is Growthpoint faring in terms of its competitors who are also facing the exact same scenario within the climate of property in South Africa?
Yeah, so obviously Growthpoint is a very large and quite complex firm. We have a very diversified range of sources of income coming from global operations, as well as a fund management business and a development business, which is less sort of predictable and maybe not as reoccurring on the development side. So we have, in our business, we have performed reasonably compared to our competitors, but there are some of the smaller competitors that are performing well, specifically those that have a niche exposure to retail at the moment, seem to be performing well. But, we're reasonably optimistic. If you have space to let, as we will have in our office portfolio, where we've seen vacancies come down from 19% to 15%, that's tremendous upside for us if we can let that. And I wouldn't be surprised if we get a bit of growth in the economy and we let all that space, that we probably will outperform many of the counters in the real estate space.
Thank you so much for your time. Growthpoint CEO Estienne de Klerk speaking to us about their latest financial results.